Hey everyone, happy Thursday, February 16th. It's about noon on the West Coast. It's time for another market update. After last week, we had a rough week with mortgage rates with that BLS jobs report and the Fed talking tough. Hopeful that this week would have gone a little bit better, but unfortunately, I'm here to tell you it did not. On Tuesday, we had a big CPI inflation data coming out on Valentine's Day. All I wanted for Valentine's Day, besides spending time with my lovely wife and daughter, is to get good inflation data, and unfortunately, we did not. The January number came in as expected at a gain of 0.5%, but the year-over-year number was supposed to come down to 6.2% and only came down to 6.4%. So things did come down, but not as much as expected, and the markets did not take that well because it backs up, what the Fed is saying, that inflation's under control and they got to keep raising rates. So anything that feeds into the Fed's narrative is going to be bad for the markets. So here's something from the New York Times kind of showing you each different category, what went up a lot. Energy has definitely went up a lot. All items, like I said, up 0.5%. Take out food and energy, it was up 0.4%. Very few things came down, actually. But one thing that's feeding into this and is a lot higher is this shelter costs. We talked about this before. This blue line is the shelter cost, the CPI in the shelter cost, which makes up 43% of that core number. You can see it's still going up at 7.9%. But this is notoriously about a year behind. So we can see this apartment list number. It went down back then and it really climbed up high and has been coming down ever since then. So it's about a year behind. So we should hope to expect this blue number to start coming down here in the next few reports we get. But up until this point, we can see it's been lagging, and this has had a huge effect on the inflation numbers. So that's one positive thing we can look forward to the future is once this corrects itself and starts coming down, then we'll see those inflation numbers come down as well. And then the next thing we got was producer inflation. We got that today. Again, that was expected to go up 0.4% this month, went up 0.7%. Year over year, it was supposed to come down to 5.4%, only came down to 6%. Feeds, again, if the producer is costing them more, they pass it on to consumers and inflation goes up, which, again, feeds into the Fed's narrative. A third thing that we get that, again, plays into the Fed's narrative as far as data is retail sales for January came in really hot, up 3%. Some of this is connected to, it looks like department stores went up quite a bit, and that might have to do with returns after the holidays, so maybe that will correct itself. But again, another data point for the Fed to look at and say, look, people are spending a bunch of money, cost of goods across the board are going up, inflation's still running wild, and we still need to stay on the path we're on. The next thing we got that, again, feeds into that narrative is initial job claims for this week. And like we talked about, this is very important because as far as the Fed's concerned is if people aren't losing jobs on paper, then everything they're doing is fine. So we're expected to get about 200,000 unemployment claims. We only got 195,000. So once again, a fourth point of data that came out this week that really feeds into that anti-market data into the Fed narrative where, hey, we need to kill inflation. We might have to have people lose their jobs for that to happen. Our job's not done. We need to continue with the rate hikes. We can't do any rate cuts anytime soon. So all this data is bad for the markets, and that led to the average conventional rate, according to that lender survey, jumping all the way to 6.78% as of today. Might be a little bit higher tomorrow because some of these numbers are still coming in. Last week, we're at 6.32%. 2 weeks ago, we were at 5.99%. So in about 2 weeks' time, we've gone up over 3/4 of a point, all off these job data, this inflation data, again, all playing into the Fed's narrative that their job's not done and they need to continue raising rates, which is up against the other narrative that they're overdoing it. They're lagging behind in their information, and they're going to overcook it and cause a lot of job loss. So we shall see what happens on that front. And because of that, because 2 weeks ago last week we had a bad week. This week, purchase apps came in at negative 6% for the week, 43% down year over year. I expect them to be down again next week because, basically mortgage rates go up, apps go down, vice versa. When we see the rates come down, we see apps go up. So with having another bad week this week, we should probably expect those to come down again. And then one piece of data I wanted to touch upon, let's go to this, is new construction data. So we got housing and start permits for January. So the two numbers highlighted here are completions, the number of single family and multifamily they expect to be completed over the next year, and permits. So completions is important because that's how many new places to live are going to be available over the next year. So that's about 1.41 million. Up against that is the household formation. So household formations is people moving out of their current situation and starting a new household. So if you're living with your parents and you go rent an apartment, that's a household formation. If two people are roommates with other people, get married and buy a house, that's a household formation. So we expect those we're at a 1.9 million annual pace right now. But they're only completing 1.41 million. We're about 500K short. So that's the reason this is important, or at least, where basically it means inventory will stay low, and that's price supported for current homeowners. So if you're a current homeowner, this is good because it means inventory will stay tight. So your value should stay a little bit more anchored. The next thing we're looking at pretty closely is permits, because permits, this $1.34 million number, is a new start. That's basically when people, the first thing they're going to do before they build a house is pull permits. So with that number down 27% year over year, that doesn't show anything in the future that indicates that we're going to all of a sudden have a huge amount of inventory and be overstocked and, that kind of thing. So, where that leaves us, no market is perfect to buy or do whatever. If, right now rates are higher, so that's definitely tougher for people on the margins. But if you can afford the higher rate, it's a softer, seller's market. So, sellers are willing to do seller credits. Builders are willing to do different credits. You have people willing to work with you and, not a lot of offers. Whereas if you wait, like everybody's supposedly waiting for rates to come down, then you're going to run into multiple offers again, 10 to 15 offers on places, things going over asking, no seller credits. So really it's, each market, no matter what's going on, there's going to be a plus and negative to it. And there's also windows of opportunity. So right now, if you are someone that can afford that payment and you have been thinking about buying a home, like I said, that puts you in a good position to actually do so because you're going to be facing less competition. So it's upon myself as a lender to work with people to find out what works best for them. And you guys as realtors that are watching this, for you guys to work with them as well to see what's going to work best for them. It's now the right time to sell. It's better to wait. What's their priority? Is it making the most money? Is it living where they want to live? Things like that. So always going to be there's always going to be windows of opportunity in every market, and there's definitely one right now. So if you need any help, please don't hesitate to reach out. Besides that, I hope everybody has a great day. We'll talk soon. Thanks a lot, guys.